Hi, this is Karen Lin. In this video, I'm going to introduce consolidation with inter-entity inventory transactions when NCI is present. I'm going to use a spreadsheet to show you how we do consolidations. Okay, if you would stop the video and read through the information that's given, it's here or it's in your notes, you're welcome to do so. And also, if you're using the McGraw-Hill textbook, it's in the McGraw-Hill textbook. Okay, so there are two companies. The parent company owns 80% of the subsidiary, and there are some intra-entity transactions between the two parties. We can see that the transfer price is it referring to the intra-entity sales between the two parties, which would be the numbers, as I said, if you draw the box, if you draw the diagram that I gave you, it is basically the number between the two parties within the box, okay? That is basically your TI entry number. So the transfer price means the price that's the seller selling this inventory to the buyer, the price that's at. Um, So in this question, it didn't specify who sells to whom because it can go either directions. It could be the upstream or to be a downstream. Let's say it's an upstream case. Okay, I'm going to demonstrate using an upstream case because a downstream case it's relatively easier. So let's go with the upstream case. The upstream case in the upstream case, which is the subsidiary selling to the parents, this is the sales number in 2018, 80,000, and the cost for the seller, which is the subsidiary, $60,000. The impact of this transaction to the subsidiary's gross profit is $20,000, and the remaining inventory 16,000, which means 16 divided by the transfer price, that's the remaining portion of the inventory. The GPR is 25%, as we said last in our previous video. If you're given the GPR, you can just use the GPR multiplying by the inventory remaining. That gives you the unrealized gain. So 2014 and 15, the structure is the same. You can see that we assume all the inventory remaining from last period will be sold in the current period. So you can see in this setup, the subsidiary recognized 16,000 gain last period, 4,000 is unrealized last period, which is deferred to this period, 2015. And 2015 has a portion, 6,000, which is unrealized, will be deferred to 2016. That's how it works. And all other information about the sales, the acquisition, and the fair value access, net income dividends are above. Okay. So let's talk about the allocation. All excess value over book value are allocated to a database, which is 50,000 would be um, amortized using 20 years useful life. Amortization is 2.5 thousand per year. Excuse me. So as we said, the unrealized gain 2014, 4,000 will be realized in 2015, and 2015 will have an unrealized gain 6,000. Go to the upstream case directly. I'm going to skip the downstream case and may come back for a little brief review of the downstream case, but I want to talk about the upstream case first. So in an upstream case, it is the subsidiary selling to the parents. So the subsidiary's net income actually contains the unrealized gain, which means the subsidiary, which is the seller, recognizes some gross profit because it sells the inventory to the parents. However, some of those are not realized, which will be contained in the subsidiary's net income. Because NCI is an idea that the non-controlling interest has an interest in the subsidiary's net income, but it has no interest in the parent's net income. Therefore, if it's an upstream case, all the unrealized gain and realized gain will be shared by the NCI. Why is this important? This is important because when you're doing consolidation, you need to predict the NCI in subsidiaries net income and the NCI accounts, which I said before in chapter 4, NCI account mirrors investment, NCI net income mirrors equity in net income and accounts. So let's take a look at the parents bookkeeping. These are the bookkeeping for you to do the first 2 columns of the worksheet, as well as for you to predict the NCI in the consolidated financial statement. So the parent has beginning investment January 1st, 2014. It recognized 80% of the subsidiary's net income, 80% of the dividend, 80% of the annual amortization of the database, right? Now there is remember there was a 4,000 unrealized gain for 2014 when I just show. If you have that printed out, you can see that there are 4,000 unrealized gain. The parent shares 80% of this unrealized gain, which is 3,200. Okay, that gives you the parent's investment at the end. Why? Because remember, when there is unrealized gain, the parent needs to recognize those, right? The parent would debit the equity in net income, credit investment. So debit equity in net income, credit investment for the unrealized gain. In an upstream case, the parent will be debiting 80% of the unrealized gain to the equity in net income and credit 80% of the unrealized gain to the investment account, because again, the NCI shares the other 20% because NCI has a share of the net income of the subsidiaries. Okay, I'm going to just write it down here just so that you have, this will not be in your notes, but I'm going to write it down on the screen so that you could understand. So if the sales is upstream, so seller is the sub, right? So sub's net income contains unrealized gain. Therefore, NCI will share that unrealized gain. If the sale is downstream, seller is parent. So parent's net income contains unrealized gain, which NCI has no share of. Okay, so that is the key. When the sale is upstream, the NCI will share the unrealized gain. When the sale is downstream, the NCI will not share the unrealized gain. So when the parents recognize, in this case, when it's upstream, the parent okay, so if it's upstream, the parent will debit equity and net income 80% of the 4,000, that's 3,200, credit investment 3,200. If the sale is downstream, the NCI has no share of that. So when the parent debiting equity of net income, it would be the whole 4,000. And it would credit equity investment for the 4,000. Okay, so when you are reading my notes, you will realize that if it's upstream, the unrealized gain, the parent would debit equity net income credit investment for 80%, that's 3,200. Next year, when it is sold, the parent will reverse what it has been done last year. So it would debit investment, credit equity net income for the 3,200. So you will see that 2015, the parent will reverse what has been done in 2014. Okay, so in other words, you will be seeing the unrealized gain got deferred in the year that's happened, but it will be reversed in the next year when the inventory are sold to the outsiders. If it's downstream, I'm going to show you this. If it's downstream, if you go back to the previous pages, you will see that the parent actually recognized the whole 4,000 in 2014 and reversed the whole 4,000 in 2015. So you can see that's a 100, and the NCI doesn't have doesn't get any impact from the unrealized gain and realized gain if it's downstream. So if it's upstream, there is a split between the two parties, the parent and the NCI, by the percentage they own. So that's what it is about. Okay, so again, in this case, the parent has unrealized gain deferred in 2014, but it get reversed in 2015. These two things basically cancel out. You can see that. In 2015, there is a new sales between the two parties, so there is a new unrealized gain, 80% of the 6,000, that's 4,800, okay? Now you will see that the NCI's record actually mirrors the parents. So of course, those are imaginary accounts. As I said, it's not on the parent's book. It's just for our convenience to predict NCI and NCI in net income. So the NCI has a beginning balance of investment plus 20% of net income minus 20% of dividend minus 20% amortization, and then 20% of unrealized gain, 800. Next year, it reversed this 800 with the NCI in net income, you can see. So in 2014, debit equity NCI in net income, credit credit NCI. The next year, debit NCI, credit NCI net income. It mirrors the investment and equity and net income accounts. Again, so because of that, you will see that the ending balance NCI is 103,800. You need this number when you're doing the consolidation. You also need the NCI in net income because this number is basically the consolidated net income attributable to NCI in the NCI column, which you won't be find anywhere else. All right, so let's talk about the upstream and downstream using a worksheet. I'm going to switch my teaching method a little bit. I'm not going to consolidation first, but I'm going to talk about the entries that we are going to use, and then we go back to look at whether it fits our prediction by intuition. Okay, so let's first take a look at the TI, G, and G star. Now, I always suggest my students to do anything starting with the star first, because that's adjusting anything that's coming from the last period. We didn't have time to cover, for example, the initial value method of investment account and then doing consolidation based on it. But if you are taking the CPA exam, it's covered. You would probably want to review the entries that with the C star. So with that, you also want to do the C star first. Okay, so in this case, the entry that with the star is our G star. It's the realized gain entry. So I'm going to do that first. I'm going to do TIG and G star first before I'm doing SAIDE. Okay, let's start with the TI entry. TI entry, debit sales credit cost of goods sold. We are reducing the sales and cost of goods sold for the amount of the intra-entity transactions. Where do I find those numbers? So in the information, you will see that 2015, the subsidiary selling to the parent. No, this is the upstream case. So subsidiary selling to the parent, $100,000 of goods, which cost the subsidiary $70,000. So the intra-entity transfer is basically the $100,000 showing here that we want to debit. So we are going to debit $100,000. Everything here is in the scale of thousands so that I don't have to input all the numbers in it. So I'm going to call this TI entry, 100,000. I'm going to also credit the same amount to cost of goods sold, right? Remember, that's my TI entry. So my TI entry has the full amount of cells. And then I'm going to go to my G entry. My G entry will basically be adjusting this cost of goods sold because I'm over adjusting it. If everything is sold out to the outsiders, TI entry will be the only entry that we need for consolidation to adjust for the impact. But this is a partial sold case, so we need the G and G star. So let's go to the G entry, unrealized gain. As we see in the information section, we see the unrealized gain is basically 6,000. Okay. Now, some people ask me why, what are you going to put in the G star, in the G entry? Are you going to put in 6,000 or 6,000 multiplied by 80%? The answer is that you are going to put in the 6,000 full amount. The reason is because we are, for example, you are doing cost of goods sold, consolidating the parent and the subsidiary. You're not considering NCI here, right? So I'm not going to differentiate whether it's an upstream or downstream, and calculate that by the percentage owned by the parent and the NCI, because the differentiation I talked about in my previous um, uh, illustration using the lecture notes, I'm actually talking about the illustration when we are doing the bookkeeping, okay? If it's downstream, the NCI is not affected by the unrealized gain and realized gain. If it's upstream, it's affected. But here we don't, because this is the adjusting entry to eliminate the whole unrealized gain for the whole entity. So I'm going to debit 6,000 unrealized gain. That's my cost of goods sold. My credit side should be my investment account because my investment account is inflated. So I'm gonna credit my investment account. I'm sorry, inventory account. I kept saying investment, but I'm looking for inventory. So my inventory is inflated because of the ending inventory of the parents contains some markup from the subsidiary. So that's the 6,000 markup that's not sold to the outsiders, contained in the remaining inventory. So the 6,000 debit cost of goods sold credit inventory. Okay, G star. G star, remember, it's an upstream case, so the unrealized gain is in the subsidiaries retained earnings at the beginning that we want to defer to this period. So, but that was 2014's unrealized gain. So the G star or star G entry should basically be the 4,000 that's realized from last period, which is in the beginning of the subsidiary's retained earnings. So I'm going to debit 4,000 as my G star entries in the retained earnings at the beginning, right? I'm crediting my cost of goods sold. Okay, so that is my G star. Again, I'm debiting subsidiaries retained earnings 1,1. I'm crediting cost of goods sold. If it's a downstream case, I'm debiting investment for 4,000. I'm crediting cost of goods sold for 4,000. Okay, but this is an upstream case. All right, this is TIG and G star. After I did TIG and G star, I'm going to go with SAIDE and the NCI column. So let me start with the S entry. S entry, remember, is stockholders' equity, so now you should be really familiar with it. It would be the subsidiaries' common stock. That is my S entry. And also there would be a retained earnings 1,1 of the subsidiary. Now, I cannot take the whole 310 for my S entry anymore because I already, through my G star entry, I already taken 4,000 out of this 310, right? This is a credit balance. I'm debiting 4, so the remaining is only 306. Okay, you can see that's my S entry. Now, if you do a 310, let's look at what happened. You do a 310 here. If you do a 310 here, your consolidated retained earnings, 1,1 of the subsidiaries retained earnings would be 4. Now that's wrong because it should be 0 because we are not adding any subsidiaries retained earnings to the parent's account. If it's a 4 debit side, that's a negative 4, which doesn't make any sense. So it has to be 306, makes this whole retained earnings 310 go to 0. Okay, so 306, I want you to remember that it's the remaining retained earnings. Now you see why we need to do anything with the star first, because if that touches the retained earnings one of the subsidiary, we want to do that before we do the S entry. Otherwise, when you do S entry using 310 again, and then you do the 4, that makes mess your things up. So I'm going to do a 306 here. That's my S entry. I'm crediting, and my S entry is the stockholders' equity of the subsidiary, and then I'm crediting my investment and NCI. So I'm going to take this 306, okay, plus the common stock 150 and multiply that by 80%. Okay, that is my investment account. That's my S entry. My another part of the S entry would be my NCI 11, but it's only 20%. Okay, that's my S entry. Okay, if I'm doing this, they should be the same. So my debit, which means my debit equals my credit. I did my entries correctly. Okay, that's my S entry. A entry. A entry, I have only the database that I'm going to take fair value excess and amortization off. So my A entry would be the database after 1 year of amortization. Remember, A entry is always about the remaining fair value excess of the database at the beginning of the year. So if I'm looking at the database worth $50,000, right? Every year it amortized by 2.5 thousand. Now, 2014 is the first year. So when we are consolidating on 2015, we are taking only 1 year amortization off because we have the E entry to take the 2015 amortization off. So the beginning balance of 2014 for the database is 50,000 minus 1 year amortization. That's 47.5 thousand. So I'm going to do it in a database. You can see it is 50,000 minus 1 year amortization. That is my A entry. Okay, so I'm going to split that between investment and NCI. This is 0.2. So that is my A entry. Okay, my A entry is basically the splitting between of the fair value assets between the CI and the NCI. Now, one student asked me in one particular exercise when she or he does the 80% and 20%, he or she says it's wrong. That is because if you have a premium, control premium case, and if you have goodwill, okay, you should remember if the parent pays more than the NCI to acquire the subsidiary, the parent has a control premium, which makes the parent's goodwill unproportional to the ownership it has. If that's the case, you should be multiply everything other than the goodwill up. Multiply that by, you should add everything other than goodwill up and multiply that number by 80%, and then adding the goodwill separately if you have a control premium case and if you have a goodwill. But here we don't have goodwill, we don't have control premium. So we are just simply splitting between the CI and NCI of the fair value excess we are eliminating or restoring for the database. Okay, that's 47.5 multiplied by these 80% and 20%. So I'm just going to do it right now. The NCI at the beginning is restored by the NCI by the S and A entry for the NCI. So if you look at this NCI at the beginning number 100.7, it basically coincides with your lecture notes. When we first talk about predicting NCI, you can see that NCI at the beginning of 2015 is 100.7 thousand. So that's what we have, which means we did the S and A entries correctly. Okay, next let's go to the I entry. The I entry should be the equity in subsidiaries earning, which we take the equity in sub earnings my debit side, and I'm going to credit my investment account. Now I have a little notes here. You can see that this 552.4 is calculated using the net income of the subsidiary minus the amortization of the database, which is the net income minus amortization, plus the realized gain from last year minus the unrealized gain from this year, and then multiply the whole thing by 80%, because the NCI in for the subsidiaries, they share the 20%, the other 20% of the realized and unrealized gain. Okay, versus if it's a downstream, you will see it's a 52, which is the 70 net income minus amortization multiplied by 80% plus all the unrealized realized gain minus all the unrealized gain. So the difference between the two is that whether your realized gain and unrealized gain are divided between CI and NCI by their ownership proportion. If it's downstream, it all goes to the parents. If it's upstream, 80% goes to the parent, 20% go to the NCI. Okay, so that's my I entry. I'm debiting this number. I'm crediting this to my investment account. Right. So that is my I entry, SAID. When I'm doing my I entry, I might as well do the NCI in net income just to remind myself if I'm doing the CI's I entry, I'm going to do something mirrors the I entry, which is the NCI in the subsidiaries net income. So what that number would be, the 70,000 net income of the subsidiary here, right? Minus amortization. You can see amortization is here, 2.5 thousand. So I'm going to minus 2.5. I'm going to plus the realized gain from last year, 4,000. I'm minusing 6,000 unrealized gain this year. Multiply that number by 20%. So that is my NCI in net income. Okay, 13.1. Or if you look at the lecture notes, if you look at your lecture notes, you will see that it is exactly 13.1 thousand in my NCI in net income's T account. Okay, so that is NCI in net income. D entry, dividend. My D entry would only be having 80% of the dividend for the CI. That's my D entry. I'm going to copy and paste this to my investment account. So I'm debiting investment, crediting dividend. Now notice that the subsidiary's dividend is 50K. You are only eliminating 40K using the D entry, and another 10,000 we are eliminating using the NCI column. That's the 20% of the 50,000 belongs to NCI. Okay. All right, last one, E entry. E entry goes to the database because the database, when you amortize it using the A entry, we only amortizing the database up to the beginning of 2015. So the amortization that takes place for the database for 2015 is actually achieved by the e-entry. So I'm using an e-entry to credit my database, and I'm debiting amortization expenses for the database. So there's no account called amortizing expense. It's just operating expense. So I'm going to just add that to the operating expense. Okay. All right. I just want to check with you the intuition behind the database consolidation. You can see A entry and E entry work together. If I'm looking at the database, the information section, you will see the database in 1/1/2014 has a 50,000 remaining value, right? 14, sorry. After 1 year, it would become 47.5 because it is 50 minus 2.5. December 31st, 2014, 15, it will be 45, right? Every year it decreases by 2.5 thousand. So this 45 should be reported on the consolidated net income, consolidated balance sheet as the value of the database, right? So if you look at this, it is exactly what it is, 45. And this 45 is achieved by the A entry, which is amortizing up to the beginning of the year, 47.5. And the other 2.5 is achieved by the E entry. So when you combine A and E, it would be the correct consolidated database number. So this should connect the dots for you for chapter 3 and 4. All right, next there is a inter-entity liabilities and accounts receivable, accounts payable sort of thing. So the parent and the subsidiary has one party supplying to the other party records accounts receivable, the other party records accounts payable. We need to eliminate those. So I'm going to debit that. It's in your information section of the notes. You can go over that. It's pretty straightforward. So I'm going to debit my accounts payable, which is under the liability. I'm going to credit accounts receivable under accounts receivable or current assets, just to eliminate the inter-entity loans between the two parties. Now let's check whether we did things correctly by looking at our total liability and total equity. They are not the same. So I'm going to figure out where I did wrong. So I noticed that my retained earnings are different from the parent's number. So I'm going to check my retained earnings at the beginning and ending. My beginning seems correct. My net income is not the same as the parents. So I'm going to check my net income. My net income is not the same. Consolidated net income attributable to CI should be the same as the CI's reported net income, but they are not the same. Why? It's because my consolidated net income is even smaller than my net income to CI because I messed up with this. It has to be a credit side balance, okay? So the credit, it should be, I am actually crediting the NCI in subs net income. I leave it as a credit balance because I set up the formula as the total net income minus this NCI's portion gives me the CI's portion. If you don't use a parenthesis, that's okay, but you need to add these two numbers up, okay? So because I set it up as subtraction, so it has to be sort of in the Excel sense, it should be a negative number, or in our accounting sense, it should be on a credit side. Okay, so that corrects my net income, and also this net income goes to the consolidated retained earnings statement equals to the parent's net income. Now this is correct. It carries over to my retained earnings. Okay, this goes to another issue my students sometimes copy. So when they set up this formula, you see where I trace this retained earnings number to. I'm tracing it to the retained earnings in the beginning. In the retained earnings statement. But some of my students would set this up as this equals to this number. If you do that, in the case I just show you, you won't find the error. You will find your liability equals your total asset because you set this number the same as the parents. You won't be able to trace back as I did to the mistake I made in my formulas before. So you would have had come to a wrong, basically a wrong net income to NCI and a wrong retained earnings statement without noticing it in your balance sheet. Okay, so that's what we did, SAIDE and the NCI column, and of course before that we did the adjustment. Now I'm just trying to look at whether things are consolidated numbers are consistent with my prediction. So if I'm looking at the consolidated number, consolidated revenue, for example, should be the parent P plus S, right? But notice that for the subsidiary, it's an upstream case. For the subsidiary, the 300,000 contains an intra-entity sales which we need to eliminate. So that's the subtract of 100,000 from the 300,000. So basically, all sales to outsiders are 600 plus the 200, which should be the 800. You can see for the cost of goods sold, when you do P plus S, it's too much because there is a um, current period intra-entity sales for the historical cost that you need to adjust. And there is also a realized gain from the last period that we need to adjust from our cost of goods sold. So if you were not given the worksheet and you were asked to predict what the consolidated cost of goods sold number is, what you do in an exam is that you add the two parties' book value up. And then in your brain, you should imagine there's a TI entry with the full transfer price. You should subtract from the P plus S. You should be then adding the unrealized gain because it's an over adjustment for your TI entry. You are adjusting it back. And then you should be subtracting the realized gain because we are decreasing the cost of goods sold to increase the net income of the entity, right? So again, it will be P plus S minus TI plus G minus G star. That is your predicted number if you don't have the worksheet. Operating expenses would be the P plus S plus the amortization for the database. If you have other assets, equipment, so on and so forth, you should add those too. Equity in subs earnings should be 0. Net income should be calculating from the above. Notice that this net income is basically, I should put it here. It is basically the consolidated net income for the whole entity rather than the net income for CI, because you need to subtract the portion attributable to NCI to derive the CI's portion in this consolidated net income. You will see this consolidated net income to CI equals to CI's reported net income. Okay. All right. I'm going to skip the rest. You can derive the intuitions behind it pretty quickly. And I'm going to stop my video here. If you have any questions, you're welcome to email me or bring that to the chat. Another thing I want to mention is that for the downstream case, it's basically similar. It's just how you calculate the equity in net income and the equity, the net income attributable to NCI is different. You will see that for some of my notes or my videos, I make the sites maybe in a different notation. I'm using all those in the credit, but they are the same intuition. In this demonstration, I choose using all positive numbers because it's easier for me to illustrate. But you will see the textbook or other illustration using other signs of the numbers, but they are conveying the same intuition that I just talked about in the video, which you should be doing in a flexible way when you read different materials. Again, remember accounting is all about substance over form. So I may do the NCI columns differently, but I'm conveying the same information. Okay, all right, I'm going to stop here. Thank you for watching. I'll see you next time.